Hello, I'm Richard Gill and welcome to Landmark's Serviced Office Video News. Today we're going to be looking at some issues relating to the valuation of serviced office companies. Many owners and shareholders in serviced office companies believe that compared to other sectors, serviced offices are undervalued. I'm delighted to be joined today by one of the leading analysts for the sector. He's a director of Peel Hunt and has been following the industry for 20 years. He is Andrew Shepherd-Barron. Andrew, thank you for joining me today. Can I start by asking you whether there's a common valuation approach today to serviced office businesses that you've seen evolve over the last 5 to 10 years?
It's a funny business. There aren't that many that are listed, and of course the main ones, Servcorp, Regis, and back in the day MWB Business Exchange, have had different valuations over the years. I think MWB was never correctly valued, but if you look at something like Regis, a typical EV/EBITDA of maybe 8.5 times is where it's at. That captures only part of the growth though, so probably the true underlying EBITDA multiple is lower.
Has the whole concept of valuing on a multiplier of turnover disappeared out of the equation now? Because the accounting rules have got a lot more complicated, have they not?
They certainly have. No, I think revenue is obviously important to running the business, but as a valuation metric, it's not something we look at. We're looking at PE ratios, free cash flow yields and EV/EBITDA, which is kind of close to the free cash flow yield in some ways.
Yeah. And just on the issue of the development of new centres, it has such a profound impact on the P&L. How does the valuer approach the development of new centres that plunges us into the red?
Well, there's a theoretical answer and a practical answer, and the stock market, at least insofar as it's looking at the likes of Regis being the sector leader, is the obvious one to look at, is oscillating between the two. The more sophisticated answer, of course, is that they should look at the rate of return that a new centre is going to make, value it, and add that to the company valuation for the existing portfolio, for example. Or you say, well, we're just going to aim off slightly, give it a slightly higher PE or EV/EBITDA to allow for that dilutive effect, and give you maybe 15 times PE rather than 12.
How does this compare, Andrew, with other sectors? The serviced office industry multiplier is seemingly to us a little bit low. Is that true? Are other sectors valued at a much higher multiplier of EBITDA?
Well, I agree with you. I think they are low, partly because the stocks have been growing so rapidly. This dilution of new openings has been dramatic, had a dramatic impact on profitability. But if you look at other sectors, what sector do they feature in? The obvious one is support services, not the real estate sector. It's a completely different model. And support services, you can take any examples you want. It's such a generic mixed bag of companies, but serviced offices should trade at least in line with the sector. And the sector's trading on 12 times at the moment.
And the sector's doing very well. I read a report from PwC recently that it's accounted for virtually all of UK GDP's growth over the last 5 years, which suggests we're in a healthy place, but it does beg the question as to why we're trading at such a discount to the other serviced sectors.
Well, I think that investors are not totally persuaded by the longevity of the serviced office model. Wrongly in my view, but you do what you can to persuade them, and they will always harken back to the prospect of a business which is effectively taking on long-term leases for short-term tenancies, being very vulnerable in a downturn. And after all, Regis did put its US business, HQ, into Chapter 11 in 2002-03.
We've had perhaps 2 recessions or quasi-recessions since then. How long do you think it might take before the investor group decides that actually it is a sustainable business through these recessions?
Well, I think, to be fair, we've been through a 2007, 8, 9 downturn very well. Occupancy rates stayed up well, and the key issue was whether or not, by lowering pricing, you managed to maintain the occupancy rates, because that at least shows a sensitivity of demand to price. And the fact that it did, and it responded neatly and almost linearly, I think is a real testament to the strength that the offer works, and that it is just a question of getting the price offer correct.